Hello everyone, it's April 3rd, 2020, and I welcome you to this Moss Adams webinar, Top 10 Actions for Executives. Before we begin, I'll read this obligatory legal disclaimer. The material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including without limitation, legal, accounting, or investment advice. This information is not intended to create, and receipt does not constitute a legal relationship, including but not limited to an accountant-client relationship. Although this information may have been prepared by professionals, it should not be used as a substitute for professional services. If legal, accounting, investment, or other professional advice is required, the services of a professional should be sought. Assurance, tax, and consulting offered through Moss Adams LLP. Investment advisory offered through Moss Adams Wealth Advisors LLC. Investment banking offered through Moss Adams Capital. So welcome again. By way of introduction, my name is Toby Johnston, and I'll be your presenter today. I'm a partner in the private clients group here at Moss Adams, and I'm also the leader of our executives national practice. So aren't these crazy times we are living in? It's truly unprecedented action in the markets with the global pandemic, the coronavirus pandemic here in the United States and around the world. My guess is most executives have spent the last 3 or 4 weeks taking care of their employees, taking care of their families, doing their best to keep everyone healthy, to keep business going. But at some point there will come a time when you can take a step back and evaluate your personal financial situation as it relates to this market disruption. And along with all of the challenges, you may find that there are also some opportunities. And so the purpose of this presentation is to go through a top 10 list. By no means is this list comprehensive, and you may have some other good ideas that we could discuss, but here it goes. So this first point is all about equity compensation. It's about stock options. So for those of you without stock options, you might tune out on this one, but reality is we could probably do an entire presentation just talking about the opportunities that afford themselves with regard to stock options when you have a market that's gone down significantly for most companies, and you have the opportunity to potentially buy and hold some of your options, and with a decreased value spread right now, value spread being defined as the difference between the current value and the strike price, or the price that you have to pay to exercise your option. For tax purposes, it's all about having that spread be as little as possible, right? Because that's what your taxable income is going to be based on with regard to exercising the option. So, and that goes for whether you're dealing with incentive stock options or non-qualified stock options. So the basic strategy here is value of your stock's gone down a lot. Consider exercising and holding with less tax consequences than you would have previously when the value was much higher. That's pretty straightforward if you are at a public company where you can just look up a stock price. A little more complicated if you're at a private company where the current value is going to be based on the most recent 409A valuation that's been done. So you may need to ask your stock administrator what that 409A value is, when the next one is scheduled. Basically, you're looking to pin down that value that has likely been reduced as a result of the crisis. So again, multiple strategies here. I feel like this is kind of a double whammy. You get basically 2 benefits here. One is potentially lower taxes. The other is you're getting into this, starting an investment position from much lower value, and so you increase the likelihood of greater investment returns over time. So just wrapping up on this first point, if you do happen to have incentive stock options, then with this potentially lower option spread, you can actually exercise more of those options without going into alternative minimum tax. So potentially your cost of exercising the options is just the strike price with no tax on top of that if you only go up to the AMT crossover. The other piece to keep in mind with ISOs is that if you happen to have already exercised ISOs early in this year, before the crisis caused any value to go down, you still have the opportunity to potentially disqualify that exercise before the end of the calendar year. So you don't have to do it right now, but there is a clock ticking. And before the end of the calendar year, you can keep an eye on that stock price, see if it recovers. If it does, great. If it does not, you might consider triggering a disqualifying disposition so that you're taxed on the lower value at the time of that disqualifying event and not the higher value that was at the time that you exercised. So that was a long one to get us started here, but moving on to the second point on the list here, which is all about estate planning, right? It's all about wealth transfer planning. Reality is that the best estate planning, the best wealth transfer planning is done in this type of an environment when you do have asset values that have decreased and you also have lower interest rates. You can get complicated with this or you can keep it simple. Simple strategy might be donating stock that's gone down in value using your annual exclusion, which is $15,000 a year now, donating that to relatives, friends, family, etc. Or if you want to get more complicated, you might consider something like a grantor retained annuity trust, or maybe a sale to an intentionally defective grantor trust. So all kinds of strategies here, but bottom line, with interest rates very low and with stock and other asset values that have significantly decreased, there's a potential for you to transfer future appreciation of those assets outside of your taxable estate during this time. Okay, moving on to number 3 here. So this is kind of an oldie but goodie. Sort of common sense, harvest losses to offset any capital gains. You may have already triggered some gains earlier in the year. My guess is you've got a portfolio now that probably has a bit of loss that you could harvest. So there's no reason why you need to pay any capital gains taxes this year if you've got losses in hand. And you don't have to wait till the end of the year to do loss harvesting. You can do that now and offset those gains and reposition. We'll talk a little bit later about rebalancing your portfolio, and loss harvesting is definitely a tool you can use to do that without hopefully incurring any taxes with that. So moving on to number 4 here, we've got basically what many people would call a backdoor Roth strategy. So you may be aware that the IRS has placed income limitations on the ability to contribute directly to a Roth IRA. So for most high income earners, most executive type clients, you can't do a Roth IRA directly. But what you can do, even if you participate in a 401k or other qualified plan, you can still contribute to a non-deductible IRA. You can do that. Your spouse can do that. That's $6,000 a year right now, unless you're senior. So you can put your $6,000 in non-deductible IRA, and that can grow tax deferred over time. Take it out; it's taxable in the future to the extent it's earnings and not basis. So the wrinkle on this is that you can have the ability to take that non-deductible IRA, which has a basis of $6,000 in it, for the example I'm describing here, and you can convert that to a Roth IRA. That conversion is actually a taxable event, so you may have tax there to the extent that you don't have basis. If you put $6,000 in and the next day you convert it to a Roth, then you basically got 6,000, converting the 6,000, and you have no earnings there to be taxed. The trick here is that the IRS wants you to look at all of your traditional IRAs or rollover IRAs and account for the basis across all of those various accounts that you as an individual may hold. So if you've got an old 401k that you rolled over into an IRA, that likely has no basis, and so and that's probably a larger account. So if you convert your 6,000 to a Roth, there's a good chance that a lot of that could be taxable. But there's definitely circumstances where this works like a charm. For me personally, I do the non-deductible. I do not convert it to a Roth. My wife, on the other hand, and that's because I have some other IRA accounts that were rollovers from previous 401ks. But my wife, on the other hand, she does not have an old 401k IRA that's rolled into an IRA. She just has her traditional IRA that she uses to do this conversion technique every year. So she puts the 6,000 in, we convert that to the Roth the next day, and we do this backdoor strategy every year. So that is the backdoor Roth, and now's a good time to put assets into the market to potentially, well, not potentially, to grow tax deferred, and whether or not you convert to potentially come out tax free in the future. So that might feel pretty good to put some tax free compounding to work. Okay, here's a variation of the same theme. If you do have IRA accounts out there, you can also convert the whole account to a Roth at any time. You don't have to, so this is not the kind of the backdoor strategy. This is just taking an existing IRA or a rollover IRA and converting that to a Roth. And so again, that's a taxable transaction. Why would you want to do that? Well, in a typical year for a high income earner, you're probably already in the highest tax brackets. That may not make a lot of sense. It may for estate planning purposes and other reasons which we won't go into today. But let's imagine this year, though, that your income is going to be significantly down. Maybe you don't have a stock compensation income this year because the market's gone down. Maybe you're an executive that's going to be foregoing your compensation this year, not taking a salary, or maybe you've taken a substantial pay cut to try to help your company weather this storm. Maybe you don't have capital gain income. A lot of reasons why your income might be lower during this crisis, right? And you may actually be in a very low tax bracket. And so that kind of opens up the window of opportunity for you to convert IRA assets to Roth at a very low tax rate potentially. And so it's something that may not normally make sense, can actually make sense in this type of an environment. Okay, moving on to number 6 here. Take advantage of ordinary loss treatment for qualified small business stock. So qualified small business stock, it's not so new anymore. It's actually been around a long time. The last few years, a lot of startup investors, angel investors, venture capital investors have become very familiar with the capital gain exclusion provisions of qualified small business stock. But you know what? There's actually some preferential treatment that can come into play too if one of those investments, one of those qualified small businesses doesn't work out. Maybe it becomes worthless, or maybe it just ends up getting sold for a significant loss. So the deal is that usually when you sell an asset in a capital transaction, a capital asset, that triggers a capital loss, and that's subject to limitations. $3,000 after you offset capital gains, you can only take an additional $3,000 of capital losses for the year. So, excuse me. The deal here is that with a Section 1244 loss on qualified small business stock, you can actually take up to $100,000 of that as an ordinary loss. And so that means that you can use it to offset your regular salary, compensation, basically any other type of income including, if we go back to the point before, including IRA conversion income. So you could have a few of these strategies working together. So just pointing out, if you do have some of those startup investments that go bad this year, and I know there's some of that happening definitely here in the Silicon Valley, keep in mind that qualified small business stock can help you on the downside as well as on the upside. Moving on to point number 7 here. You know, one of the things about selling real estate or repositioning real estate is that, you know, people don't like paying taxes on that, right? And so they tend to want to do a like-kind exchange, Section 1031 exchange, because if done properly, you can keep rolling your gains into the new property, and you can defer tax, and that works for federal and state. But there's a lot of complications that can go along with that. And you know, different windows of time that you have to complete that transaction in. You have to identify your property and complete the transaction, et cetera, et cetera. So if you're in a position now where your real estate may have gone down in value, you may still be looking to reposition. The point here is that all of that becomes a lot easier if you can do it with minimal taxes without using Section 1031. So it's kind of a silver lining there that you might be able to, you know, facilitate some of your real estate portfolio rebalancing or repositioning without having to worry about Section 1031. And you know, the way I think about this is as long as I'm moving up in the real estate market, if I'm selling some property so that I can buy something that's, you know, more expensive, more valuable, and even if I sell for a lower value, as long as I'm buying something that's also gone down in value, if I'm going up, I'm going to come out ahead either way. So don't get too down if you are moving up, and it can still work out in your favor. Moving on to point number 8 here, you might have thought this would have been the first point, but it's an obvious one. Chances are the equity side of your portfolio has gone down quite a bit. Hopefully the fixed income side of it has held up quite a bit better. So your allocation, your asset mix may be off now. And if you're like me, I traditionally, you know, rebalance my portfolio twice a year, sometimes once a year. I'm not going to wait this year. If I wait all the way till the end of the year, I may, you know, very well may, you know, miss part of the market rebound. I'm not a market timer. I don't know when it's going to rebound, but I do believe in having a disciplined long-term approach to the market, and I believe in holding as best I can to my asset allocation. And so it's likely time to rebalance, and probably sooner rather than later. Definitely not wait until the end of the year to do that. Okay, moving on to point number 9 here. So, you know, sometimes we think of fixed income as sort of all being conservative and not having the same characteristics of equities. And while that is true, there's a lot of fixed, you know, not all fixed income is created equally, right? And so now's a good time to be reviewing your fixed income portfolio, looking at the credit quality, looking at the interest rate sensitivity, looking at the maturities, the duration of that portfolio, and seeing how that's reacted in the market. And you may need to do some repositioning there as well. Okay, moving on to our last point here. On this one, don't want to end on a down note here, but you know, estate planning and getting a basic estate plan in place, updating our estate planning documents, it's often something I see clients put off. You know, life gets in the way, and sometimes we find it difficult making it into that attorney's office or making that call to get our documents updated. Now is definitely a time when a lot of people are thinking about that, and based on the conversations I've had with my estate attorney contacts, they say business is keeping right along, and they're actually very busy right now. So if you don't have an updated estate plan, If you've got one that's way out of date, or if you don't have one at all, now's a good time to do that. Especially if you do not have an updated medical directive, take care of that as soon as you can. You want to go to an attorney to do that, but if you're in a pinch, there's forms online that you can do in the interim to get something in place, just to give you a little more peace of mind. Okay, so with that, that is our top 10 list for today. Again, my name is Toby Johnston, partner here at Moss Adams. I welcome all of your questions. Best way to get in contact with me is to email me. Go ahead and shoot me your questions, and I'll do my best to get back to you. And in the meanwhile, everyone stay safe, and hope you're well, and I hope you're managing well with your company and with your families. And yeah, stay safe. Okay, thank you. Bye-bye.